Hello and welcome back to the Microlearning Institute. In this short tutorial we're going to have another look at IAS 12 taxation, and specifically we're going to look at how to deal with the tax base of a liability. Let's consider an example. Okay, so this example asks us to consider each of the following liabilities which appear in a company's statement of financial position as at the 31st of March 20XX. And for each of these liabilities, assuming a tax rate in this jurisdiction of 30%, calculate the amount of the deferred tax liability or asset which should be shown in the statement of financial position in relation to the liability. Liability 1 tells us that current liabilities include accrued expenses of €5,000. These expenses have already been deducted when computing both accounting profit and taxable profit. Now pause the video if you want to consider how this should be treated for deferred taxation purposes. In this case, when the expenses are paid, they will not be liable for tax. So consequently, there is no timing difference between the tax treatment and the accounting treatment. And as a result, there is no deferred tax implication. The next question considers or asks us to consider that current liabilities include accrued expenses of €8,000. These expenses have already been deducted when computing accounting profit, but will not be deducted for tax purposes until they are actually paid. Pause the video if you want to consider the solution to this question. When these expenses are paid, they will be deductible for tax. Therefore, there is a timing difference of $8,000. And as a result, the company recognizes a deferred tax asset at the rate of tax. That's $8,000 by 30%, equating to €2,400. And again, we recognize a deferred tax asset in this case as the expense will be recoverable in future periods. Thank you very much for looking at this short tutorial on how to deal with deferred tax issues in relation to liabilities.